I love investing for income and having cash flow within my portfolio. I'm not a purist. I understand that long term, growth assets tend to outperform dividend assets. But with that said, income producing assets have very distinct advantages, and in different market conditions, they can really complement a growth portfolio. And if you've been following the channel, you know my two favorite high income ETFs are jepi and Divo. jepi currently has a dividend yield of 7.3%, which is extremely above the average, and Divo has roughly a 5% dividend yield. And the only sustainable way to generate these high dividend yields is through an options strategy, and that's what both Divo and jepi utilize. Now, with that said, I'm not a huge fan of QYLD because this takes it to the extreme. So we can see an 11% dividend yield, so this covers 100% of the underlying index with at the money covered calls, which means there's essentially zero room for any price appreciation. So almost all of the total returns are just the premiums collected and paid out to you in the form of dividends. And this isn't all bad. I think QYLD can be used in a portfolio along with other assets in a pretty efficient way. But the reason why I prefer jepi and Divo is because they don't go to the extreme of QYLD. So they give you exposure to equities, which allows you to capture some of the upside in the market. So this is the total returns of jepi and Divo side by side, and over the past 12 months, they've both returned around 20%. It does lag behind the market, but that's the trade-off in order to receive 5 to 7% of this return in the form of cash dividend payments. Now here's where QYLG comes into play. So this is a spin-off of QYLD we just talked about previously in this video, and this is a lot less extreme than QYLD, and it tries to aim for that same middle ground that Divo and to a lesser extent jepi try to take. And the major difference between QYLG and QYLD is that this ETF only writes covered calls on half of the underlying index, which allows the other half to appreciate along with the market. But the trade-off, of course, is in comparison to QYLD, the dividend yield is exactly half. In fact, we can actually visually see this on the chart. So the QQQ is the ETF that tracks the Nasdaq 100, which is the benchmark for both QYLD and QYLG. So if we add QYLD, we can see just how much it lags behind the underlying index because of that extreme strategy. But now if we go ahead and add QYLG to this, we can see that it goes right down the middle. It has exactly half of the price appreciation of the QQQ and half the dividend yield of QYLD. And in this video, I want to compare QYLG versus Divo. Now they have extremely different strategies and approaches, which is what I'm going to break down in this video, but ultimately their total return over the past year has been almost identical just by coincidence, along with a very similar dividend yield around 5%. So the first thing we have to do is quickly establish what a call option is, because the call options are a critical portion of both of these ETFs. All a call option is a contract that can be bought and sold on the market, much like equities themselves, but they're derivatives. And there's three major components of a call option. And essentially what that is it allows the buyer of the contract to buy a specific stock at a specific price during a specific period of time. And that's it. And we can represent that with this visual graph right here. So on the x-axis is time, and on the y is the performance or the price of an asset. And this could be anything. This could be an index like the Nasdaq 100, or this could be an individual stock like Apple. In fact, let me change this to price to be a bit more simple. And this red line represents the call option, which has a strike price of $60. And at the time of writing the contract, the price of the underlying asset was $50 per share. The time period is 1 month. So let's say this is Apple stock that you own. It's currently $50 per share, and you want to sell a call option with a strike price of $60 that expires in 1 month. The reason why you would do this as the seller is because you would collect a premium for selling the contract to somebody. And in Divo and QYLG, that premium is the dividend that is then paid out to you. So as the month goes on, if the price of the asset remains below the strike price, the contract will not be exercised because it doesn't make any sense to buy it at $60 per share when you can still buy it at $50 per share. The equation changes though if the price of the asset goes above the strike price during that predetermined time. So let's say during this time, the price of the asset goes up all the way to $70 per share. The person that paid the premium and bought this contract now has the right to buy the asset from you for $60 per share. And this is how call options can limit your returns because they put a ceiling on the maximum amount of price appreciation you could have based off of the strike price that you set. So in this situation, of course, you would collect your premium and you would have $10 per share of price appreciation before they get called away from you because of the call option. And the final important thing to note here is the closer the strike price is to the actual price of the asset at time of writing the contract, the more valuable the contract is, and thus the higher premiums collected, which are then paid out to you in dividends, forming a higher dividend yield. And the trade-off there, of course, is if the strike price was set at $51 per share, you would have next to no price appreciation, and all of your return income would be from the rather high premium from the contract. Now, the situations that call options really shine is actually in flat or declining markets. So in this situation, we have the strike price of the call option very close to the actual price of the asset. So it's essentially an in-the-money call option. This allows you to collect the highest amount of premium possible, but we can see during this time, the price of the asset moves sideways, it kind of goes down a little bit, and it never goes above the strike price. And because of that, the contract is never exercised, so you get to keep the underlying asset along with the premium you initially collected. So you can see how in flat or declining markets, call options are a great way to boost returns and even mitigate some potential losses. Although in bull markets, they do tend to cap your returns. Okay, so let's see how QYLG uses covered calls in their strategy. So QYLG follows a covered call or buy right strategy in which the fund buys the stocks in the Nasdaq 100 index and writes or sells corresponding call options on approximately 50% of the value of the portfolio of the stocks in the same index. And if we come over to this document, we can see a bit more insight on exactly what kinds of call options they use in this ETF. So this says here, after settlement of expiring call option, a new at-the-money call option expiring the next month is then written, a transaction commonly referred to as a roll. The strike price of the new call option is the closest listed strike price greater than or equal to the last value of the Nasdaq 100 index reported before 11 a.m. So this is what's known as a systematic covered call writing strategy. Every month, generally on a Tuesday, as they say right here, they write at-the-money call options on, in this case, 50% of the underlying index. So coming back to these examples, the time frame here is 1 month, and the strike price is, as we just saw, as close as possible to the current price of the asset. So that's not going to allow for really any price appreciation on the half of the portfolio that these covered calls are written on top of. But it does, of course, maximize the premiums received. And that's why if you come back to this comparison of the QQQ versus QYLG, it has roughly half the returns with the same price movements. Now, Divo, on the other hand, is extremely different on a fundamental level. So Divo is an ETF of high-quality, large-cap companies with a history of dividend and earnings growth, along with a tactical, covered call strategy on individual stocks. And down here is a bit more information on Divo's selection methodology, and over here they have a breakdown of the two income sources. So the strategy seeks to provide gross annual income of approximately 2 to 3% from dividend income and 2 to 4% from option premium. And if we open up the actual holdings of Divo, we can exactly see what this strategy is doing. So they do indeed have those large cap blue chip dividend growth names like Microsoft, United Health Group, Apple, Visa, Honeywell, so on and so on. And down here, they publicly list their active call options. So they currently have call options on Apple, Caterpillar, and Visa. And that's part of the opportunistic nature of these call options. It's not systematic. So they don't cover 100% or 50% of the portfolio. It's just done on an opportunistic basis as management of this ETF sees fit. Okay, so now let's move on to the comparison portion of this video. So I want to begin with the similarities between Divo and QYLG. And the first one is that exposure to equities and thus the upside potential of the market. This is something I always look for when I'm evaluating different high dividend ETFs, because long term, you're going to want some exposure to the upside of the market that equities can provide. And looking at Divo and QYLG side by side, their total returns, over the past year, they've returned roughly 19-20%. So there is some upside capture. As we mentioned, they both used covered calls to generate at least some of the dividend income. And lastly, they both have similar growth and dividend yields. But that's where the similarities between these two ETFs end. And now let's move on to the differences. So the first major difference is QYLG uses an index approach and Divo uses an opportunistic call strategy. Now, in terms of which one is better, I honestly do not know. Now, just generally speaking, when it comes to actively managed versus passively managed ETFs and indexes, one really doesn't have an advantage over the other. It really just depends on what's happening with the market and who's managing what ETF. So Divo uses active and QYLG uses passive, and so far, just by coincidence, they happen to have very similar performance and dividends. A lot of people knock on QYLD and subsequently QYLG for using this very simple, systematic, monthly at-the-money covered call writing process, but so far it's been reliable. And QYLG, by only doing it on half the portfolio and letting the other half grow, I think is only an improvement, but time will tell. The next major difference, aside from the call options, is actually what these ETFs invest in. So Divo actually invests in those blue chip, large, stable dividend growth companies, and QYLG invests in the NASDAQ 100, which is an index of high growth tech stocks. So essentially polar opposites. In all fairness, within Divo, we do have some tech names like Microsoft and Apple. Both are great, high quality companies. Tech and other high growth names found in the QQQ tend to outperform these traditional dividend companies, although they also tend to be way more volatile along the way. But if you keep in mind that QYLG caps the returns of half of the portfolio with these at-the-money call options, that's why they currently have almost identical returns, and that's just by coincidence. Now, there is one major physical difference between these two strategies, and that is the dividend growth. So because Divo actually invests in dividend growth companies, their dividend does grow over time. So looking at 2020's payments, the average was around 13 cents per share, and in 2021, the average is around 15 cents per share. And coming over to QYLG and looking at the actual payouts, the history of this ETF is extremely limited, but so far there's really no growth in this payout, and that's to be expected based off of its strategy. But again, just like before, there's no definitive answer as to which strategy is best. Moving on to the next one on this list, QYLG's dividend is 100% from option premiums collected. And Divo, as we saw, 2 to 3% of the dividend is from actual dividends paid by companies, and 2 to 4% of it is from call options. So if you want to look at it in this way, Divo is slightly less dependent on the performance of its call options to generate its income. As mentioned, I love having income and cash flow in my portfolio for a couple of reasons. The first is stability, so that dividend yield is way more stable in nature than the growth rate of various assets, because that can be very unpredictable. Another reason why I'm a huge fan of high income and covered call ETFs is because they act as an insurance policy against bear and flat markets. Coming back to this example, if the market is flat or even declines for a long period of time, if you're a pure growth investor, you will have significant losses along with the market. But covered calls can be a way to consistently generate a consistent return in the form of these premiums, which can be used to offset potential losses. But of course, during bull markets, covered calls do tend to limit your returns. And statistically speaking, we're actually in a bull market, I believe 78% of the time. And that's why I'm not a purist. I have both growth and income assets. Jepi and Divo are two of my favorite options within this category because they have good dividend yields and they do give you some exposure to equities and the upside potential that they offer. And for those same reasons, I think QYLG is actually a great option. Coming back to the differences between Divo and QYLG, the main difference is the index versus opportunistic approach, so the passive versus managed. And honestly, I do not know which one is going to be better long term. And as we saw, so far they have almost identical returns. So let us know in the comments down below which one you'd like better. If you're still watching and enjoyed the video, give it a like, subscribe to the channel, all that YouTube stuff, and I'll see you in the next one.